14th AIBI Annual Convention brought together over 1,500 leaders from India's capital markets ecosystem at the Geo World Convention Centre in Mumbai. Anchored around the theme IPOs India, Gateway to Global Capital, Sustainable Growth, Vikasita Bharat, the convention offered a comprehensive deep dive into evolving landscape of India's primary markets. Through compelling keynotes, insightful fireside chats, and high-impact panel discussions, it traced the full journey of capital formation and market expansion. Today, we bring you a special panel discussion anchored around the theme Decoding the Investor Lens, Expectation that Shaped the Market. This session explores governance standards, valuation discipline, market cycles, and the evolving benchmarks that shape investor expectation in today's dynamic market landscape.
I'll start with Prashant, you first. I still remember last year you told us that Indian markets are facing a bit of a time correction. Now it looks like there is a price correction as well. As we head into 26, given the painful 25 that we saw, what's your sense? How are you approaching this market from here on?
No, I think in large caps we have seen only time correction.
Time correction, correct.
But in small mid caps, I think we are seeing price correction as well, which I think is warranted.
Okay.
And I think they became very expensive. And I think why they became very expensive is in COVID they fell very sharply. And therefore the returns from that low base were much higher. And if you look at the number of demat accounts today, 70 or 80% of the demat accounts have been opened after COVID.
Yeah.
So these investors have no experience of prior to COVID market cycle.
Right.
So they have extrapolated last 5-year high returns in small mid caps. And that is what has driven these prices much above fair valuations.
Yeah.
I think this space is still expensive to my mind.
Okay.
And it should probably both time and price correct more.
In the broader markets, you mean?
In the small mid caps.
The small and mid cap, the broader markets, yeah.
So I think,
Okay.
I don't think we are at the end of this adjustment
Sure.
phase. But in large caps, I think the risk reward is now favorable. But our return expectations have to be realistic and in line with the low inflation environment that we are experiencing.
Right. Prashant, I remember, I was reading last year one of your shareholders letter that you give to your shareholders, and you very clearly said, I'm tempering the expectations. If 10-12% is what we make, we'll be happy. Now I think it becomes a realistic thing that, okay, even if you make money, that'll be good. In that context, what is the expectation should one have? And within that, which are the few sectors that you feel should do well from here for the next 4-6 quarters?
See, I think to set expectations, you should be aware that India's nominal GDP is unlikely to grow beyond 11-12% CAGR. And India is increasingly becoming a more competitive market across industries.
Sure.
So many new business models are coming. Private equity is funding so many new businesses. Almost every company is getting capital in the primary markets.
Yeah.
So I think it is good, but it also means that the marketplace will become a lot more competitive. So there is very limited margin upside in any sector to my mind.
Okay.
So I also feel while large caps have undergone time correction, but they are not cheap. They are now at fair multiples.
Sure.
So I would say, in my opinion, if you take a 3-5 year view, Nifty should deliver low double-digit returns.
Nifty should deliver low double-digit returns.
Low double-digit returns.
Okay. Okay. So that means you're still further
11-12%.
11-12%. Okay. Okay. I want to come to you, Mr. Kishore. I'm speaking to you for the first time, but as Prashant said, a lot of the retail investors have come post-COVID, post-2011 and all, 21 ke baad. In that sense, in the last 1.5 years of correction, what is the behavioral change that you've observed among the retail investors?
So, one thing is that normally we have observed that, IPO frenzy is continuing.
Okay.
Although secondary market has been what it is, the subscription levels and the participation level in the IPOs continue to remain healthy. And we see a lot of first-time investors actually entering the market through the IPO process. So in that sense, the incoming flow is continuing.
Okay.
Which also means that the quantum of money which is chasing the limited quantum of stock that we have is still remaining in that same quotient, meaning the number of investors coming in directly as well as through mutual fund route is only increasing. And incremental money coming into the market is also on the rise. So the price correction that Prashantji talked about and probably the market is waiting about is also yet to happen because the flow of the money is still on.
Yeah.
And the quantum of stock available is the same.
Right.
It's not increasing in the proportion in which it should for the quantum of money which is coming in. So we have not seen any major deviation in terms of the behavior of the investors. They still continue to throng into the IPOs. They still continue to come into IPOs and they are as interested in IPOs. You would see even the last one which got closed a couple of days back had 9 million investors participating.
Yeah.
Now that only shows that the interest that the investors have is not coming down.
Sure.
It is only remaining at that level. So one has to really now prepare for that environment where the number of investors coming in and the quantum of the fresh issuance happening is matching somewhere.
Okay.
So we have not seen any major difference in terms of the IPO subscription and also in terms of the number of investor accounts that we saw. In last 5 years we have seen huge amount of increase. At some point in time, probably 3-4 years back, we were serving say maybe about 40 million investors. Today we are 145 million investors. So that only shows that the interest hasn't come down. It is remaining high still.
Sure. Prashant, I want to ask you something to take it forward. You've seen 30 years of this market. You've seen every bull cycle, bear cycle, and you've been with the mutual fund for almost 3 decades now. Typically, when the retail investor panics out of mutual fund? Because that's been the big backbone of this market, right? In the last 2-3 years. From your experiences, when is that the retail investor panic in the mutual fund industry?
So I think the past is unlikely to be a guide to that. Why do I say that? Because few things have changed in India. One, the understanding of equities as an asset class has vastly superior today than it was in the past.
Sure.
So the second is that the volatility of Indian markets has fallen by half in last 20 years.
Sure.
If you look at India's beta compared to global markets, it is nearly at an all-time low.
Yeah.
And that is because so much money is coming locally. So it has become a virtuous cycle.
Yeah.
More money has driven down volatility. And third thing what has happened is the taxation. Fixed income is now taxed at marginal rate and equities are taxed at a lower rate. So even if returns are low, the post-tax return gap is much higher than the past. So I feel because of these 3 reasons, the flows in mutual funds are likely to be a lot more stable than the past. In the past, we have seen that when 3-year returns started becoming zero, that is when they tapered off. I don't think we are there.
Okay.
And even if that happens, it may lead to some moderation, but not maybe a drop. But yes, if for 5 years you don't make money, then clearly I think it will lead to a lot of pessimism and it could start showing up in the flow numbers also.
Okay. Sudhir, from a private equity perspective, give us your thought process on how you look at investments in the capital. I mean, of course, you do both listed as well as unlisted. From the listed perspective, what is the multiples idea of looking at investments? What's the thought process like? What are the areas that you're keenly looking at investing right now?
No, so from an investment perspective, for us, we try to be not very focused on whether it's a listed company or an unlisted company. For us, the fact that it is we are chasing alpha in a few companies, right?
Sure.
So it is not while we do have some level of diversification, but it's not a complete diversification approach. So it is a little bit of where is that solution capital that can go in and make that 25% return that really matters.
Sure.
And that could be dependent on whether it is ownership transition of a certain kind, whether it is significant capital that is required to take company from level A to level B. And that option exists largely in the private market, but even in the public market, there's a slew of mid-cap companies which go in, which doesn't have the investor research, which doesn't have large investor coverage, where those opportunities exist when there is some transition event that is there. So we look for those opportunities to see, obviously competing in the in the public market with the public market players, you can't make that 25%. You have to, it has to be a specific situation where you can put your management inputs, you can put a new management in, you can improve governance, take it to another level which will allow you to make those returns. So those do exist in the public market, but deal making in the public market is a lot more difficult given takeover regulations and so on and so forth.
In the last 1 year, because of the correction in the broader markets, has that opened up a lot of opportunities for private equity like you? I know you've recently closed one deal in buying out VIP, but otherwise, in general.
Yeah, my sense is definitely there is a inverse correlation between private equity activity and public
absolutely.
market activity, in the sense that a lot of mid-cap companies which would otherwise have probably taken private equity capital would probably go into the public market.
Sure.
We keep advising entrepreneurs that go into the public market when you're ready, when you know that for the next 8, 10, 15 years, you can sustain the performance of the company and to build that to a certain scale rather than go prematurely. But having said that, the temptation of the public market is always very large for entrepreneurs, and therefore people do go in, and that in many ways creates opportunities for you on it at a later point in time. But I wouldn't say that we are very driven by market corrections as such. It has to be situation specific.
Absolutely.
It has to be a particular situation that exists in the company which is driven by circumstances which are very particular to that company, which create opportunities for us.
Right, right. Pranav, coming to you, I know IPO has been a big talking point. Last year was a record year. This year also expected to be a record year. But just give us an experience on what happened last year in terms of the fundraise, and how much of the IPOs that have been listed are below the issue price, just compared with last year figure.
Well, so, 2025 was the second year in a row when you had an all-time high figure for IPOs, which was the first time in India's IPO history that you've had two back-to-back years. You had about 103 IPOs, raised close to 1.75 lakh crores. As far as the listing performance is concerned, you did see a drop down from the previous year, from about 30% in 2024 to about 10% last year. If I look at the current market price, I think, you would have a 50-50 situation.
Okay.
With roughly 50% of the stocks trading above issue price and the balance below.
So, Prashant, one question to you. I mean, as you said, only 50% of the IPOs of last year are above the issue price. As a fund manager, how challenging it is to identify few winners out of those and really bet them? Because I know you've been very selective in the IPO market.
So I think one should.
And what's the thought process basically? How you identify those winners?
So I think one should approach IPOs just like you are investing in the secondary market.
Sure.
If you approach it that way, then I think it is quite simple. But for that, you need to let go of the thought or the temptation that I'll make some money on the pop basis.
Right.
See, in IPOs, we are at a disadvantage compared to secondary markets because you are dealing with people who are far more knowledgeable about that company, the sellers.
Yeah.
Whether it is the promoters or people like him, the private equity investors. In a secondary market, there is no, I am not at a disadvantage.
Right.
And there is a track record which is available of the company. So I think we approach primary exactly like we approach secondary markets, and basically look for sustainability of business and reasonability of valuations. These are the two guiding principles.
Basically, the message is don't have a FOMO in the IPO market. That's the message that you want to give, right?
There cannot be a FOMO in a 5 to 10 market. You can buy as much as you want.
Yeah, you want to say?
No, I was saying that, I think it's an unfair expectation that we have, that we expect all IPOs to give a positive return on listing and also to continue to trade in the positive for the entire life cycle.
Right.
So I think, after an IPO company gets listed, it becomes like any of the other secondary market listed companies whose share price will move up and down on the basis of how the company, of course, is doing, how the sector is doing, how the economy and the markets are doing. So I think we should, put an end to this analysis of 3 months later, 6 months later, 2 years later, because ultimately they all become like your other listed companies.
Right. No, I think that's a fair point. I don't expect every IPO to do well. But, Pranav, the other aspect of this market last year, for the last few years, has been the big exits of promoters and private equity investors through the capital market. It's become a India has become a very easy exit market as well, so to speak. I was talking to Sudhir on that. But what's been the data in terms of how much has the promoter sold out, how much has the private equity sold out, and what's been the trend there? I mean, what's been the performance of those companies after the exits?
So, last 3 years, 2023, for example, I took out some data. So 2023, you had 1.36 lakh crores of promoter
Promoters
exits.
exits.
2024, you had 1.42, and calendar year 25, you've had 1.58 lakh crores. Of course, you had large promoter exits of Airtel and Indigo, which inflate this figure. But I think one thing which has to be looked at is that the market has taken it in its stride. Of course, like we were discussing, a lot of it, a lot of this is backed by the huge inflows which are coming into mutual funds because they are the buyers in most of these cases. I think with these promoter exits and even with PEVC exits, what needs to really be looked at is that what is the stake post the transaction?
Yeah.
Do they still continue to have skin in the game or not?
Yeah.
And has that transaction happened at a discount? And is it also accompanied with deteriorating fundamentals of the company? If not, then, I think we are evolving as a capital market ecosystem. I think this is also a very positive sign to foreign investors in terms of ease of exit. That अगर आपने पैसा लगाया तो फंस नहीं जाएगा, आप निकाल भी सकते हो बाद में.
Sure. Sudhir, you know what? As you said, there's so much of promoters and private equity exits. What has been your experience? Have you seen a lot of that promoter money coming back into the market through family offices or through other other sorts of investments?
So it's a circular thing. End of the day, the money finds its place, as we all know.
Sure. Yeah.
So promoter exiting here would definitely invest somewhere else. So we have seen some of these things happening.
Okay.
If not directly into the market, they have their family offices created, which also again somehow investing into the capital market or in the other economy, in one or the other company. So basically, the circulation does happen.
Sure.
And our data shows that ultimately it is not bad.
Okay.
It is in fact a healthy sign. Because the money rotates, and the moment the money rotates, it finds its right place at the right price. So I think it's good to have in that sense. We find that it's pretty okay.
Prashant, your thoughts on promoters exiting? A good sign, bad sign? Old thought will say that we should not look at positively.
No, I think if promoters don't exit, see whether they exit or they dilute, it is one and the same thing.
Yeah.
So I think it is good for capital markets to prosper. It gives liquidity. It increases your weight if you have more floating stock. So I only worry about companies where there will be no dominant shareholder left
Sure.
after 5-10 years. So, and we are seeing that mostly in private equity backed companies, that the people who started those companies, they are eventually in some cases left with minuscule stakes. So what happens to these companies 5 years, 10 years down the line? What is the governance? I think that is the issue which I am sure other countries have gone through that. It will throw up more opportunities for M&A, takeovers. But these are companies I would be cautious about in participating because the governance structure is still not reliable in that sense. And we are seeing that a lot of NBFCs, for example, or even in larger companies, promoter stakes are hardly.
Correct. Sudhir, we all talk about opportunities, investment ideas, and whatever. One thing I want to ask from you, from being from a private equity side, how should one look at exits? I've learned over these years that everybody teaches you to buy, but nobody teaches you to sell. Tell us, as a private equity investor, how do you approach exits into your investments, apart from the forced investment, which is the closure of fund. Otherwise, what's the thought process like?
So typically you have to know that private equity at the end of the day is a closed-ended fund.
Yeah.
You have a life of 10 years, 12 years. You can make investments over 3 to 4 years. You have to exit in the residual 6 to 7 years. So one has to be very disciplined about the exit process. I don't think we can kind of say that now the market is good, let me exit everything because, or I'll exit after 5 years. It has to be, you have to be continuously in an exit. So the way we run the process at Multiples is that every year once the investment period is over, we kind of say that, okay, if we have to give this amount of liquidity to our investors, which are the investments that could provide that liquidity? And we always have a exit committee which is looking at, okay, these are the 3 companies which are likely to go for an exit this year, next year. What do we need to have to do before that exit happens? Whether the exit happens through a IPO route, it happens through a strategic route. what do we need to do it, and then systematically exit over a period of time. Many companies that we have invested, we have been able to exit even before the company went IPO, because there is a lot of momentum action happens before IPO. There are new investors coming in, pre-IPO investors, and we find those all absolute good routes to exit, because it ensures that from our liquidity perspective, our responsibility to investors as we manage a 10-year fund is met. So exit is a disciplined process that runs. Sometimes you are happy that you kind of got into a good IPO window where you got good prices for it. Sometimes you see pops happening, you exited and the stock went up and so on. But all of that is part for the course. You are kind of invested for a particular investment thesis. Once you meet that, you see how you can systematically exit, is the way we think about it.
Prashant, you want to share your thoughts on how should one look to exit?
No, see, I mean, I run a listed equity fund, so, but I would agree with him. We are not, I think any transaction at whatever price it is available, whether it's an exit or a primary capital raise or an OFS or a QIP or a secondary market, I think it is the approach is essentially the same.
Sure.
Of course, when private equity is exiting, then there are two additional considerations, that at times the numbers we have seen after some of these exits tend to moderate. And so one has to be cautious if you have seen a sharp improvement in the financials of a company that is raising capital in the last 1-2 years. And second is, what are the subsequent tranches that will come to the market over the next 1-2 years. So these are two additional considerations. But still, if the company is strong, if the pricing is reasonable, I see no reason why mutual funds or other investors should not participate in these. And there have been many cases where PE has exited and still investors have made considerable amounts of money.
Sure. One word on, see what we spoke about, the IPOs or the exits of last couple of years. What is in store for 26? Because there are some large names which are lined up in terms of IPOs. But generally, what's the pipeline looking like from an IPO perspective?
No, I think the pipeline is the strongest that we've, of course, ever had. Last I checked, there are about 200 companies looking to raise 2 lakh crores, which are already with SEBI approval or awaiting SEBI approval. And as we know, there are several more in the pipeline in terms of which are yet to file, including your Geo and a couple of others which are lined up. I think both as far as the IPO activity is concerned or even the block activity that we spoke of, I think a lot of it will continue to be driven, as I like to call it, on the basis of faith of the Indian retail investors who are continuing to pump money into mutual funds. And that is ultimately what is supporting buoyancy in the primary market and facilitating these exits in the secondary market as well. Okay. So I think as long as that continues, as Mr. Jain said, then we should see another great year for in 26.
Okay. I'll do a quick rapid fire 1, 2, 2 questions with all four of you all, because I think we're just short of time. I'll start with Pranav, you first. What to your mind would be the biggest IPO of 26?
Geo. That's
Geo Finance?
Yeah. Geo.
Okay. Geo. Okay. Kishore, what is the biggest investor shift that you're expecting in 2026, if at all the markets tend to continue to underperform?
No, I think the trend will continue. We do not see any major shift happening. The numbers may actually surprise us on the higher side. I believe that the participation level would go up. So according to me, the numbers would go up higher than what we all expect.
Okay. Sudhir, buyout or growth capital? What will be the focus of private equity investors in 26?
Buyout.
Buyout? As what you've done with VIP?
Clearly, as there is a family transition challenge that the Indian market is facing, in the sense that there are, and that's something that private equities are now geared for. Over 20 years, the experience has built up, the confidence has built up to be able to take ownership and run companies. So that's something that will go.
Prashant, one sector that you think will be the star of 2026?
Pardon?
One sector that you think will be the star of 2026?
One sector that
sector. You can't ask. I can ask you stock. So I'm asking for a overall sector. One sector which can do very well.
I think banks should do reasonably well. I feel large banks.
Large banks. Is that your big call for 26?
There is no big call in this market. There is nothing which is deeply undervalued.
Okay.
There is hardly anything which is undervalued also. I think most companies in large caps are fairly valued. So I don't think there is any big money, quick money to be made in these markets.
Okay.
But yet I feel large banks are positioned quite well as we go into next year.
Okay. I think enough of market done. I'll ask one question each, which is non-market. To you first. Do you expect India to win the World Cup this year? Yes or no?
No.
No. Okay. So your take on politics. Do we expect any major rift in politics this year?
No, I think we'll continue to
we're
have
pretty
what
much
is
stable.
very stable. I think this is, in spite of the fact that it is coalition government, I think we're pretty stable.
Okay.
So I don't expect any major, except for the international geopolitical situation, which of course is challenging. But I think in India we are safe.
Okay. So given your past investment in PVR, will Durandar 2 will do well or Pushpa 3 will do well? Or who can break the records?
At this point, Durandar 2, I can't.
Prashant, you spoke about banking. PSU bank or a private bank? Your top choice.
I think large banks that are evolving as platforms,
Okay.
whether public or private, I think will increasingly become less important.
Okay. I think we are done. I just want to ask you one last question, just because you spoke about banking and all. Given the kind of money, FDI money that financial markets saw this year in India, right from RBL to Shriram to, 5-6 large deals happened. How do you read this transition of big, foreign FDI getting in and getting into a very critical sector like financial?
No, I think it is very good. These institutions, these organizations needed that FDI, and even the country needs FDI. Because last 2 years, because of large promoter sell downs and PE exits and MNCs listing in India, diluting their stakes in India, our net FDI has become zero. India cannot afford to have net FDI zero. So to that extent, the sharp spike in inbound FDI in these institutions, I think is good for the country, and certainly it is good for those businesses as well.
So
If I can add here,
are you going to write more checks then? As what Prashant said, more FDI, I mean, you would have to write more checks?
See, my sense is money, at least in private equity, waiting to come into India continues to be at a fairly high rate, and opportunities are increasing as I mentioned for PE to come in. I wish that we were a little bit more, as we were mentioning on the chat, that we were a little bit more bold in terms of various initiatives, like for example disinvestment and so on, because this is the pricing is right, the opportunity is right, the country can get a lot more capital, do really bold things rather than be incremental in a lot of stuff that we do.
So I
was just trying to add there, because we are aware, we have been talking, being part of MUFG and otherwise, been talking to some of these bodies who are wanting to invest, and the kind of money which is waiting out to come into India is probably very huge.
Sure.
We'll have to prepare ourselves for that. I think we are yet not ready. As he rightly said, maybe some disinvestment, some other. So I think we need to act on some of those things to really bring that money, which is really waiting out.
Okay. Gentlemen, thank you very much for your time. I guess we are out of time now, short of time. So thank you very much for all your perspective. Thanks, Pranav. Thanks, Sudhir.
Can we have a big clap?
Prashant. Thank you very much. Really appreciate it.
Thank you so much, gentlemen. Thank you so much for your time. Upon your exit, gentlemen, we have a small token of appreciation, which will be handed over to you by Mr. Siddharth Shah, an AIBI board of member.